Hello and welcome to the Global View on this Thursday. Well, the US Federal Reserve has left interest rates on hold as expected, but it continues to leave the door open for future rate hikes as it acknowledges the strength and resilience of the US economy. Here's what Fed Chairman Jerome Powell had to say.
Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Given how far we have come, along with the uncertainties and risks we face, the committee is proceeding carefully. We will make decisions about the extent of additional policy firming and how long policy will remain restrictive based on the totality of the incoming data, the evolving outlook, and the balance of risks. Recent indicators suggest that economic activity has been expanding at a strong pace and well above earlier expectations.
Meanwhile, US job openings increased in September, pointing to persistent labour market tightness. The Job Openings and Labour Turnover survey showed layoffs dropping to a 9-month low, with 1.5 job openings for every unemployed person in September, well above the pre-pandemic ratio of 1.2. The US private payrolls increased far less than expected in October, while a survey from the Institute for Supply Management showed that companies could be resisting hiring, with its measure of factory employment declining sharply in October. Well, the US 10-year Treasury yield fell to a 2-week low after the Fed held interest rates steady, the 10-year yield falling to 4.76%, the 2-year dropping to 4.94%. And yields did fall ahead of the Fed decision after the Treasury Department said it will slow increases in the size of its longer-dated auctions. This comes after the US government cut its borrowing estimate for the current quarter to $776 billion. $76 billion less than it forecast in July. Well, the US dollar held on to gains following the Fed announcement. The Aussie dollar has surged in overnight trade to be up at 64.1 US cents. Well, to get across what we heard from the Fed and also an outlook for the Eurozone, I caught up with Mathieu Savary from BCA Research.
Fed pause seems to be becoming more and more of a hold at this point. The way Powell kind of dismissed the September summary of economic projection suggests that maybe amongst the committee, the number of potential supporters for an additional rate hike this year might be declining. Moreover, he played down a bit the surprise in wages that we observed earlier this week. So this language suggests to me at this point that the Fed is becoming increasingly comfortable with its stance. Rates will need to stay there clearly for an extended period of time so that the effect of monetary policy continues to be transmitted to the economy. But ultimately, I think that especially with the market reaction in recent months with higher yield, the Fed is quite happy as financial conditions and monetary conditions are tight enough to have an impact on growth.
So as we heard from the Fed, reiterating that they're seeing that underlying strength of the US economy. But a different story, of course, in the Eurozone. Mathieu, what's your outlook there, given we have had some more data showing persistent weakness in the Eurozone, I guess particularly for some of the larger economies, in particular Germany?
Yeah, Germany continues to be affected by the weakness in the global manufacturing sector. This morning, we received a lot of update on global industrial activity with the PMIs around the world. In China, that remains weak. The ISM manufacturing in the United States has deteriorated further. And we know that the Eurozone and Germany in particular is very sensitive to the evolution of the global industrial sector since it is a manufacturing heavy economy. So the weakness that we are seeing in the hard economic data and in the PMIs in Europe is very much consistent with this weakness in the global industrial cycle. That being said, there are a few little positive signs here and there. Thinking about Germany in particular, the ZEW survey as well as the IFO survey have turned up. Looking at the European Commission's confidence survey, they've surprised to the upside. In fact, the economic surprise index in Europe are starting to catch up a little bit to the US after being very, very depressed in relative term recently. So it suggests that growth in Europe is weak. It's nowhere near strong, but it's not collapsing either for now. However, we do see significant risk in 2024 for the European economy and a heightened chance of recession.
So, Mathieu, of course, the ECB leaving rates on hold at its last meeting, but we are seeing those effects come through of tighter monetary policy, of course. Is it your argument that while the Eurozone will avoid recession this year, it's perhaps inevitable early next?
Absolutely. That is the big picture for the Eurozone. Right now, what can help the European economy is two factors. The first one is that European inflation continues to slow quite rapidly. And this means that real wages are picking up after contracting severely in 2022 and earlier this year, which is likely to allow consumer confidence to improve further after already rebounding this year. And historically, this is quite positive for consumption, and consumption represents more than 65% of the Eurozone GDP. Secondly, yes, the global industrial cycle is not doing great. We've seen an additional purge in inventories, but the new order to inventory ratio is actually improving globally and in economies that tend to lead the Eurozone, such as Sweden. So this suggests that there is a bit of a room for a stabilization. But the problem is the following, which is that destabilization will prevent the ECB from cutting rates for the next 6 months at least. And as 2024 rolls on, we'll see that there is more and more refinancing taking place in the corporate sector, in the government sector, in certain countries, household sectors, specifically Spain, where more than 75% of mortgages are at the short end of the curve. And the impact of those higher interest rates will result in significant belt tightening. And this is very worrisome because already credit activity is very weak. So if households and businesses tighten their belt, start to have to spend more money on interest payment and therefore invest less and buy less, then it pretty much guarantees a recession in Europe by the second half of 2024. One risk I would add to is that US economists at BCA Research do anticipate a recession by the end of the second quarter to the early third quarter of 2024. 15% of European exports go to the US, so it's still the largest trading partner of the Eurozone. The second largest trading partner is the UK, an economy that is not doing well either. So the external sector is also likely to create a very strong headwind against European growth next year.
So, Mathieu, with the prospect then of a looming recession, what's your outlook for European equities?
Well, European equities are very sensitive to the global environment, to global reflationary forces, and in the near term, they have room to rebound. Our view was that they would correct, if you look at the Euro Stoxx 50, toward 4,000. We did hit 4,000, and they are technically at a solid level. So why would they rebound here? Well, I think the answer comes from the Fed. The Fed increasingly sounding like the pause is a hold is likely to allow a bit of a decline in fixed income volatility. The changes in the Treasury issuance schedule that we've also witnessed are consistent with a bit of an easing in bond yields. And if we do get this improving picture in fixed income volatility, at this point in time, it's likely to lift all risk assets, including the high beta euro market. But that's very near term, because when we think beyond the next 2 to 3 months, and I'm probably being very generous when I say 3 months, the outlook is pretty dark because equities tend to discount recession roughly 6 months ahead of said recession. So if we do anticipate a European and global recession by the middle of 2024, in all likelihood, this means that global equities and European equities in particular, that are so cyclicals, are likely to peak very early in the first quarter. So if you're very much a tactical investor, yeah, buy European equities, but don't expect to hold them for very long.
And just to finish up, Mathieu, there are those unknowns too, in particular how the Middle East crisis could potentially play out, the impact on energy prices, in particular oil, should that conflict widen. What would the impact on the Eurozone be?
Yeah, so this is probably the biggest left tail risk to European economic activity in terms of bringing forward a recession and bringing forward a downside to the euro and to European equities. Right now, there's a lot of lack of clarity, but the Middle East crisis does increase the odds that oil prices rise. We already have a very tight energy supply with Russia and Saudi Arabia that have elected to curtail their production of oil. Now, if we get shocks related to Iran also messing in Iraq, this could curtail further oil exports to the global market and put oil prices higher. Europe is purely an oil importer and energy importer. So it's a very negative terms of trade shock for the Eurozone that will weigh on European assets, contribute to tightening financial condition in Europe, all of that being very recessionary and very negative for all the European plays.
Mathieu Savary from BCA Research. All right, let's check where we're likely to get going in a couple of minutes' time when the market opens here. SPY futures indicating a solid beginning, up 0.75%. Now, just before we go, a reminder, registrations are now open for our next virtual investor event, Small Caps, Big Ideas. It's back for this year and will be bigger, better and faster. If you weren't a subscriber in previous years, we bring you 10 of Australia's leading small cap fund managers to each present one high conviction idea. And this year, we're throwing in a fast and furious special edition of The Call featuring microcaps chosen by you. You can register to watch live or on demand at ausbiz.co/smallcaps23. That is ausbiz.co/smallcaps23. Stay with us, the open is next.